Hello, welcome back. In this video, we are discussing JD.com and they just reported earnings. They are up 9% in the pre-market, as you'll see here, and we'll see what's going to happen when the markets open, of course. But in this video, we're going to examine the company and what happened with China overall, because the whole Chinese market seems to be up today, probably pushed by JD as well. But it's not only JD there. The reason is not just JD, and I also just made a video about Alibaba talking about what's going on, which is also up about 8% right now. So what's going on? If we take a look at the news here, you will see that JD.com and Alibaba jumped at least 6% when this article was made. Right now they are more like 8 and 9%. Because JP Morgan changed their minds about Chinese tech stocks, which they now see leading big gains in Hong Kong. Remember that they said that the Chinese stock market was uninvestable 2 months ago, only to come back and say that they made a slight mistake, a little typo. After there was a massive sell-off in China, then they said, okay, we made a mistake. Maybe China is actually amazing. So, this is one of the core things that has actually been helping the Chinese market, of course, and overall the market sentiment that is also boosted by news that Shanghai is actually planning to reopen in phases starting next month. Remember that we talked about this potentially happening in previous videos. I've made maybe at least like 5 videos telling you about how the sentiment is going to change slowly about the Chinese market and China and companies like Alibaba or JD.com, because that's how it works. That's how you make money out of a cyclical pattern which is happening right now with China. First, the sector is getting beaten down and all bad news continue to amass. That's how you beat down the sector. And then all of a sudden everything turns positive, because that's how you make money out of beating a sector. And so generally speaking, the stock market works a lot like that, in a little bit of a different fashion in some situations, but it's always about a cycle. It's the easy way for the money, for the smart money to actually make money. And so, yeah, this is what is happening right now. But let's take a look at the actual earnings. Like, what did JD.com report? What is happening? So they did report pumping. They actually report extra online sales, an increase in online sales, and the massive earnings growth, as you will see here. And as I have talked about in the past, when a stock gets beaten down immensely, then analysts' expectations are much lower than before. And so you can see an insane beat in terms of earnings just because expectations were low, very low to begin with. And it happens a lot, of course, with companies that go down like 50% or 60%. It's only normal to expect less from a company that has been completely annihilated in the past months. And this is a story of what has been happening with JD as well, because you will see here that they did say that their diluted non-GAAP earnings for the first 3 months ending in March came in at 2.53 Chinese yuan per share, well ahead of the consensus forecast of 1.62. But notice that this is just a 2.5% increase from the same period last year. So year-over-year increase has been 2.5%. Yet look at the difference. It's almost twice as much what they made from the consensus. So this is how it works. I mean, you're getting an insane surprise beat because of expecting less. And now group revenues also rose here ahead of what the Wall Street consensus was. And active customer accounts also jumped 16.2%. Another good thing to see for the company. Now, interestingly, marketing expenses were up 24.4% to just over 1.4 billion. Remember, I made a video about a couple of days ago in which I was talking about how to fully analyze a net income statement from scratch, pretty much. How to analyze the income statement. And in this one, I talked about operating expenses, which marketing expenses are part of, and how actually increasing operating expenses can lead to better profit for the company. And this is a case that seems to be happening with JD right now, because they are increasing their marketing expenses and efforts pretty much, spending more. And this seems to be bringing in the big names such as Starbucks and Unilever here. So if you are spending money the right way, you can actually bring in more customers, and that can help, pretty much sustain and grow your business. Very important. Just lowering operating expenses is not always the good thing. It may actually be the bad thing to do. Now, you will see here that we have seen a lot of bad news in the past. As you'll see, Tencent has actually dumped shares in the e-commerce group some time ago, and there has also been a plan from them to transfer most of their stake as a dividend for shareholders here. So, interesting to see what's going to happen with Alibaba as well in the next few weeks, where there's going to be the report for Alibaba too and the other Chinese companies. But even if this doesn't follow through what is happening today, in the long run, as months progress, I'm pretty sure, again, I've talked about it many times, positive news will start creeping up about China, will start amassing, and we will eventually see that the whole narrative is going to change, and we are likely going to be getting much better, higher, actually prices, not better, for the Chinese segments. Okay, so let's take a look at the stock, JD.com, what is going on. Now, the P/E ratio of the company has been negative, and that mainly has to do with what has been happening lately with the company. You will see that they haven't been doing their best in the past couple of years or so, and we will examine that in detail, of course. Yet their price to free cash flow ratio is actually very positive here. This can happen in some situations. We will examine the financials. Outstanding shares are a little bit higher, about 10%. That's not a great thing to see, of course. You want your stocks, you want your companies to actually buying back shares, but it's a better idea to do it when the stock price is low. We're going to examine whether that's the case with JD. Now, their total liabilities to free cash flow ratio is almost where we'd like it to be. A little bit more total liabilities than free cash flow than we typically want to see. About 5 is what we do like, but 6 is definitely fine here, meaning that the company would take about 6 years of last year's free cash flow to pay back all the total liabilities here. Now, the net income growth has been the problem with the company because they have had a massive slump in 2021, which really brought down their net income, as you can see. But the revenue has been growing, free cash flow has been growing, and total equity has been growing, of course. You will see here that the company doesn't have a lot of debt, but they also have a negative return on equity lately because they were losing some money lately, and so this affects their returns here, of course. But that's not the overall story of the company, because one bad year cannot necessarily mean that the company will be going down or that it is a bad investment. And if we take a look at the income statement, you will see here that the revenues of the company have been increasing massively, like threefold from 2017. And if you take a look at the net income, yes, we had a negative year, but before that we're sitting in the billions. And so it looks like we had a very bad year in terms of what JD.com was doing in 2021. Yet, as we are seeing the company unraveling for the next years, it seems like sales are getting better and the bottom line is getting better. So we're expecting to see an increase in what the company is doing in the next few years. It may not be up to par with what is happening here, but we're going to see that in the stock evaluation tool, and we're going to be starting from this level here pretty much of revenue and net income. So we'll see what we think about the company's future really, and whether it's a worthwhile purchase here. Now, the balance sheet of the company shows us that the total equity has been growing tremendously from 8 billion to 38 billion in 5 years. That is absolutely insane growth over here, of course, as you can understand. A little bit of an additional paid-in capital, of course, because the company has been selling some stock, but the total equity increase is absolutely insane. And the cash flow statement. Now, remember that cash flow gets kind of generated from the net income, beginning from the net income and adding values back to it. And you will see here that it's a non-cash item here that actually changed the net cash provided by operating activities here and made it very positive. So the net cash used for investing activities minus 11 billion here, which means that the company has been investing in themselves, and the net cash provided by financing activities sitting at 3 billion, which means that the company has been getting some extra debt over here, quite some actually, from 2020 here, about 8 billion here and 3 billion here. Now, the cash that the company has been increasing pretty nicely as well, from 4 billion to 12, so it's like 3 times as much. The free cash flow from 2 billion to about 6.65 right now is where we are sitting. Interesting. So let's take a look at the stock evaluation tool now and try to discover what kind of price it makes sense to pay for the stock. Now you will see that the revenue growth of the company has been enjoying has been tremendous, but what we do want to do here is be much more conservative for the next 5 years. So we're going to go, let's just say 8, 10 and 12 here, and let's use an income margin here, net income margin of about maybe 2, 4 and 6%. Again, 2021 wasn't their best year, but before that they were doing about 2 and 6%, so we're gonna go in between. The free cash flow margin that we're gonna use is something rather typical. I'm gonna go something like 80, 90 and 100. Whoops. Sort of like a typical free cash flow margin compared to the net income that the company generates. And an annual return of 13% is what I typically like to ask for from my companies. And if we hit calculate, we're seeing that we're well within our limits, well within our projections here for our medium and high estimates, yet we're outside for our low ones. Now the company has been battered down so much that we have arrived at a place that where our medium estimates here with 10% revenue growth, 4% income margin and 90% free cash flow margin are already met. But remember, this kind of net income margin can be a little bit too much, has only been achieved by the company in 2020 really. We'll see whether that happens, but you can even go with 2 here, and if you go with 2, you will see that you are sitting outside your range, what you'd like to see. Maybe a net income margin of 3, which is much more likely, is going to be a little bit better, sitting at $43 here, our current price being at 51. Now remember, the stock is not going to open at 51 right now, because in the pre-market it's up 9%, it's going to open up at 56. So it may be a little bit more than what I'd like to get, but I could definitely see someone opening up a position here, although I think it's slightly more elevated than what I would like to see. I still think it's a potentially interesting addition to a portfolio right now. Looks like it could be a good play, but you know, you have to account for the fact that the company hasn't been doing greatly in their last earnings seasons. Basically the last one, for the most part, it has lost money, and you have to you know, consider that. But in the reversal period, when things reverse and you know, Chinese market goes back to normal, and it looks like JD is actually doing much better in the next few quarters, at least that's what they're reporting, we can expect their net income to increase and start going back to their normalcy, to its normalcy. And so yeah, this is what I wanted to talk about in terms of JD. Looks like it's pumping up China today along with the rest of the news. We'll see what's going to happen when the market opens. But thank you for watching this one, and if you did enjoy it, please remember to leave a like and subscribe. You can always become a Patreon and get access to this tool as well. You can find links in the description box below. And in the meantime, take a look at this video that I made earlier, and I'm discussing Alibaba and how this whole thing is affecting the situation with this company as well. Thank you for watching. I'll see you soon. Bye bye.